Hello, everyone. We look like we're getting off to a good start here today. This one's going to be a fun topic to discuss, and it's going to be interesting to see what kind of feedback we get from everyone. I'm going to be doing things a little bit different here, but let me just go ahead and kick off first by saying, welcome to everybody. This is our Lifeonaire Global Connect call, and this is a call that is open to the entire community. We like for these calls to be informational. We typically do a good bit of teaching on these calls, and we'll take some questions at the end. But this is a call that I'm actually hoping for a good bit more participation from all of you. And I would love to get your feedback, your contributions, because what I want to talk about here on today's call is simply private lending. And we can look at it from the perspective of hard money lending, private lending, but regardless, I'm going to talk about some of the definitions and how I see it. I've been doing this now for about 24 years with working with private lenders and being a private lender myself. And I want to, almost make this a call of best practices, and where those of you who have been lenders, maybe you can share with us, some of the things that work for you. At the same time, if you are not a lender, I don't want you to be discouraged. In listening into this conversation, you are going to learn a lot, and you're going to get into the head and the mind of a private lender. You're going to learn just by listening to the discussions. And if you have any questions as a result of that, I want you to go ahead and bring that up. And so I'm going to give maybe, we have a lot of people who are just still making their way into this right now. I'm going to give just a couple more minutes to allow more people to join us. But while we are waiting for people to join us, I'd love to hear, who is on the call. Maybe you can raise your hand using the function to raise your hand that has done or is doing, private loans. And you may want to, contribute some to the conversation. So if you don't mind, maybe raise your hand using the raise your hand function. And all right, cool. We got 3 people so far who have raised their hand. We've got others. Okay, we got 4. I've got others on the call who I haven't seen their hands. Okay, we got a 5th one. I haven't seen their hands go up yet, and I know they're lenders. But it'll be good to get all of your perspectives. Hopefully, we can all walk away with something new here. We can walk away with some tips on, what to do and how to get started as a lender. And hopefully, in addition to that, not only do we learn how to become a lender, but for those of you who need to borrow, you might learn the best ways of working with lenders. So, all right. Well, let me first go ahead and I'm going to kick off and just sort of tell a little bit of a story about myself and my journey as learning about this business. And so when I first got started in real estate investing, it was in 1998, and I had come out of a failed restaurant business. I was broke. My credit was shot. I didn't have any income coming in. But in the midst of all of that, I wanted to become a real estate investor. I wanted to start flipping houses. And I got to tell you, I can relate to anyone who is just trying to figure out how in the world am I ever going to become a real estate investor? I can hardly pay my own rent this month or something, and you're telling me to go out and get $100,000 to get a house to do a deal. And it just seemed like it was an obstacle that would be very, very difficult to overcome. And that's the way that I felt when I was first getting started in the business. I had heard and learned that, hey, there's people out there that will lend you the money to do a deal, and if your deal is good enough, they'll put it up and things like that. But it was still hard for me to believe that somebody would give me tens of thousands, let alone hundreds of thousands of dollars to do it. And I really, really struggled with that. But I didn't let that hold me back. I decided that I was just going to keep on moving forward. And so as I was out there trying to get my first deal, I ended up putting a deal under contract. Within a short period of time after having that deal under contract, I had talked to somebody about it, another investor, and that investor wanted to purchase that property from me immediately. He wanted to, $2,000 assignment fee. He wanted to take that property off of my hands. I talked to another investor about it, and another investor said, do not flip him that house and make only $2,000 on it. He said, I'll put up the money for that deal. You and I will fix it up, and you'll make a lot more money than $2,000. And then still, in addition to that, I had another person who then was willing to actually put the money up, but I'll talk about that here in just a moment. I decided that I was going to partner with my friend who told me not to assign this deal. He told me to, he would put the money up. And then here we are. I am a few days away from having to settle on this property. And then he's not coming up with the money. And I was like, uh-oh, what am I going to do now? And that was a pretty tough spot to be in because I had already figured things were going to be nearly impossible. And this one guy who told me he was going to help me to get it done was now just flaking on me. So the guy who wanted me to assign the property to him, I had actually reached out to him at one point and asked him if I could work for him. And if he would teach me the real estate investing business and about flipping houses, and he blew me off. But now once I came to him and I actually had a real deal, he became a lot more interested in talking to me, and he was willing to spend time with me. And he actually made a deal with me and told me that if I went out there and started finding properties for him, he would, at that point, he would just pay me a finder's fee for all of those deals. And so I'd already proven myself to him now that I knew how to find a deal, and he was willing to compensate me for everything that I brought to him. Well, the time that I had worked for him in the next 6 weeks, I brought him 7 deals, and he paid me $1,000 for each one that I brought to him. I made $7,000 in the next 6 weeks. That was the most money I had ever made in my life up until that point. And while I was working with him, I realized he was getting private money to do his deals, and he had multiple sources. And I'll just have to confess to all of you, I was riding with him in his vehicle one time, and I saw him dialing on his cell phone the phone number for one of the private lenders. And I was watching him dial it, and I memorized that phone number. I kept repeating it over and over and over. And as soon as I got out of the car with him, I wrote down the number. Well, here I was now a few days before I was supposed to settle on this property, and my friend who was supposed to put the money up flaked. And I decided to call that private lender. And so I made the phone call, and I let him know that I had this house that I was purchasing, and I told him the address. I told him what I was buying it for. And I heard him typing in the background. And the only thing I can assume was he was looking up some information on the property. The internet was in its infancy in those days, but I was in a good area. I was in a good town. He was very familiar with the area. And he started asking me some questions. He said, well, so how long have you been doing this? I said, this is my first deal. And he said, so how's your credit? I said, it's not very good. He said, how much of your own money do you have? I said, I don't have any. He was asking me all these questions, and I gave him zero reason to lend me the money. And by the end of the call, he said, I'll have the money at the title company tomorrow, and I hope you do well with it. And now I got off of that call just blown away that he actually said yes. And it took me maybe a couple more years to be able to look back and realize why he said yes to me. And the reality of the situation was I had such a good deal, he couldn't lose. He knew the area well, the numbers worked. If I would have defaulted, he would have been in an even better spot because he would have been able to take the property back and make the money that I should have made on it. And he would have made more doing that than he would have had I actually just made the payments to him and and did what I was supposed to do. So it was really a no-lose situation for him. And that was the reason why he actually put the money up. Now, he didn't want to see me fail. As a person who is a lender who has been lending now for a long time, I have had to foreclose a few times, and it's not fun. There's nothing fun about having to foreclose on somebody and having to go through that process, and it's a long, painful process. Anyway, so over the course of my next year in the business, now I had this one private lender. I got to meet another one who I borrowed millions of dollars from. I got to meet him shortly thereafter. I had another one who I met who I probably borrowed millions of dollars from. But within my first year of being in the business, I had a list of 25 private lenders that were willing to lend me money. In my entire career, of those 25, my first 9-10 years in the business, I only ever used 4 of them. I never, the 2 of the ones that I was using had more money than I could possibly have ever spent. And so I couldn't use all their money if I wanted to. But putting that aside, I learned a whole lot about this business. I learned a lot about private lending. And one of my goals and one of my desires was to become a private lender myself. I was doing my first loans myself probably about 2 to 3 years into the business, where I was lending people money. The loans that I was doing were very small at that time, but nonetheless, I got my first tastes as a private lender within just within a few years of being into the business. And so there's been a whole lot that I have learned. And so I want to just go over real quick what I see are 5 and maybe 6 benefits of being a private lender. And then if anybody else has any other thoughts or anything else that you want to contribute to this, I do want this call to be sort of interactive. I would love to hear your ideas, but here I would say would be the 6 top benefits of being a private lender. Historically, this has been going on for a long time. This works. It's a proven model. This isn't something that is new. It's been going on for the ages. And so with that in mind, while you're friends and it might not be happening around the discussions that you have around your kitchen table or things like that, it is happening all around you. And so this is a proven model that you can plug into. Secondly, is that you can have predictable and strong returns. You can make good money being a private lender. I think most people who are consistently private lending outperform most other investments that they could possibly be in. Another one is that it generates cash flow. I spent many, many years of my investing along with many of my peers as we've been, growing up as real estate investors, really focused on net worth. But at the end of the day, cash flow is the thing that sets you free. And if you've got excess cash laying around that you can begin to put to work for you and have checks coming in every month, it's those checks that come in every month that really set you free. Being a private lender is can be a form of diversification. So you might have other investments, but to take some of your assets and put it to work as a private lender would be very beneficial. And finally, it's also a secure investment. When it's done right, it's a very secure investment. Can you lose? Yes, you can lose. I'm in the midst of one right now that I'm going to lose on, but it has more to do with the borrower was just a fraud, and I'll be licking my wounds from this one. But on the other hand, my private loans, which I don't do a whole lot of them. I don't do I would say that in the scheme of things, it's a small part of what I do. I made just under $100,000 last year on the interest from the loans that I am doing. And when I say that that's a small part of my business, that's pretty nice to make that kind of money when it's a small part of your business. And then so another benefit here is that it's not hard to do or to get into. A lot of times people think that you have to have a ton of money to become a private lender. And here's a funny thing, that my son came home from school and they were having them look at what they would like to do when they grow up. And they were given a list of different occupations to choose from. And this is coming from my son, who has a 4.26 GPA. He's got like a 35 on his ACTs. He is going to get free rides to many colleges. He'll get many offers because of how well he is doing academically. And he's looking for all the things on that list that he can do without going to college. But he said they didn't have flipper on there. They didn't have real estate investor on there, but they did have property manager and they had real estate agent. You don't have to go to college to become a property manager or a real estate agent. So I picked those as my top two. And then he talked about wanting to be a lender. And my wife said to him, well, you need to be a trust fund baby with a whole lot of money to be a lender. And he just like looked at her like, what? And I said, that's not true. And anyway, so that is one of the other benefits. It's not true. You don't have to have a lot of money to get into the lending side of this business. You can do it with small amounts of money. You can be creative and get your career started as a lender. The more money you have, the better it gets. There's no question about it. But I love the idea of people getting started out with small amounts and getting into the discipline of being a lender and putting their money to work for them, instead of waiting till someday when they finally have enough, in their mind to actually get started. But if you can get started with putting small amounts of money to work for you as a lender, and that's the way I did it. My very first loan was for only $2,500. And it was a second mortgage that helped somebody to get a deal done. Now, over the course of the next year and a half, I had put about $150,000 in change, that between notes that I created and money that I loaned to people. And all of a sudden, one day I woke up and I was around the first of the month, I was having $2,100 in checks coming in from those loans that I wasn't doing any work anymore. I mean, this was $2,100 a month. Now, I want you to keep this in mind real quickly as I say that to you, that a couple of years earlier, I was completely broke. And that $2,100 a month was enough to sustain the lifestyle that I was living just a couple of years earlier. And so there was this tremendous sense of security and freedom that was coming from those little checks that were coming from a bunch of different people for all those little second mortgages that I did. And there was a lot of freedom that came from it. So before I go further, I want to talk about some of the things that are important with becoming a lender. Is there anyone else that might have something that you want to contribute as far as the benefits of being a lender? Did anything else come to mind that I missed, something that you feel would be important for those who are listening to hear? All right. Well, I guess I did a good job. So I'm going to talk now. I'm going to sort of shift toward a couple of the things that I have learned throughout the years that I feel are important when it comes to being a lender, and some of the things that you should know and do the right way in order to make sure that this business does treat you well. First of all, there's many different things that you can lend on. Some people start out lending money on cars. They lend money on mobile homes. They do little mobile home deals where they'll buy a mobile home, turn around and finance it to a purchaser. They'll do loans on houses. They'll do businesses. one of the things that I first started doing when I got started was, I told you about the little second mortgages, but the other thing that I was doing where I was becoming the lender on a much bigger scale was I was buying a house using my private lender's money. So he would lend me the money and he was charging me 15% interest. So he was, not only did I borrow millions from him, he probably made $1 million or more off of me over the years that I was borrowing from him. But I was borrowing, say, $50,000 to buy a house at 15% interest. And then I would sell that house to somebody at $80,000 at maybe 12 to 15% interest. But now what had happened was if I did it at 15% interest, the first portion of that payment was going to my lender because he was getting 15% on 50,000. The $30,000 spread, I was getting the 15% on the spread between his and mine. And so in those particular cases where I was wrapping his mortgage, so he had a mortgage in place and mine was wrapped around his. His was still there. I had to pay him, but the new person who bought the house bought it from me. I was the one who provided the financing. I didn't need $80,000 to become the lender. I used the asset that I had purchased using his money, and then I wrapped his mortgage to become the lender. And the spread between the two was how I got paid. So that's one creative way that I was doing it. And so I want to just put that out there just to help all of you to realize that, there is creative ways to become a lender. Now, I want you to just think about that for a moment. One deal like that, a $30,000 spread at 15% interest would make me about $4,500 a year. And when you find yourself in a position where you can begin to wrap those mortgages and create those spreads, you don't have to do too many of them to have a significant impact in your own cash flow and things like that. So just keep that in mind. But while there's many things that you can do business loans, car loans, mobile home loans, there's house loans, all different kinds of things that you can do loans on. The one thing that I highly recommend is that you know something about the assets that you're lending in. You don't want to just put money up in a arena that you're not familiar with, that you don't have some form of expertise. And the reason why is because you need to be able to do your own due diligence to establish whether or not this is a good loan. And so due diligence is what I think is the number one thing that everybody who's going to get into this business needs to do. In recent years, I have seen a lot of people, and I've seen this throughout my career, but I have seen a whole lot of people in recent years throw due diligence out of the window, and they just hear 12% returns, 15% returns. They got money in the bank, and they just start writing checks. And that really disturbs me quite a bit when people are that flippant about lending money to people just because the high returns appeal to them. They they listen to what the borrower is telling them as far as what the value of the property is. Well, it's a $250,000 property and they're buying it for only $175,000. And so they just lend without even confirming, is it really a $250,000 property? I have a good friend who has millions of dollars. He wants to be a lender. And just last month, he was coming to me with a loan and he was asking me to teach him how to be a lender. And then so he came to me with this loan and I said, I wouldn't do it. I did my own due diligence in a matter of about 5 to 10 minutes. And I said, that's a one that I would not do. And then he told me, well, it's my brother who's coming to me to borrow the money. And I said, well, do you want to be a lender and learn how to be a lender? Or is he going to get the family grace, because he's your brother? Are you willing to do this? He said, no, I want to do this thing right. I don't want to give my brother any different deal than I would to somebody else. And when I broke it down, I showed him what the comps were. And I said, here's the real comps. And this is where your brother really needs to be in order for this to be a deal that's worthwhile for you. If he wants to pay more for it, I would tell him to come up with the spread, and he needs to be the one who does comes up with something of his own. And, let's just ignore the fact that it's your brother. I'm having a hard time telling you that, do this to your brother, but for others. To make a long story short, it ended up better for all of them because now his brother got to go back to the flipper who he was buying the house from and negotiate the deal, and he got the house for something like $8,000 to $12,000 cheaper than what he was originally going to pay in order to be able to get the funding done. And so my due diligence helped them all. But the reality of the situation is you have to do your own due diligence. Do not trust the investor. Do not trust their numbers because they want to get the deal done. They're going to give you numbers in the best light that they can. Never trust a wholesaler. That doesn't mean that they're not telling you the truth, but always confirm, always verify for yourself, what the real numbers are before you go for something. Because at the end of the day, if they don't pay you and you have to foreclose, that collateral is your security. That house, that whatever it is that you're lending on is going to be your security. And if you do this right, you should be able to come out every time. But if you make a mistake and don't do your due diligence, that's the time when I see people getting hurt. That's when I see them when they lose because they made an assumption or believe somebody else's numbers. I'm dealing with somebody right now who has to foreclose on a property where he put up $350,000. He was told that the property was worth $750,000, and he just assumed, well, this is a great deal, and that was the extent of his due diligence. The borrower told him it was worth $750,000, and the borrower never made the first payment to him. And now, as he's going through the foreclosure, he is realizing that on its best day, if the property was fixed up, it might be worth $350,000. And so he's probably going to lose $100,000 that could have been avoided with 5 to 10 minutes of doing his due diligence and going and researching the values for himself, which is easy to do today. So I'm going to stop there for a moment. That's my number one recommendation to protect yourself as a lender, is to always do your own due diligence. Would anyone else like to share something that you do in your business that may be helpful? It doesn't have to be along the lines of due diligence, but something that you do as a lender in your business to do well as a lender, or that contributes to your success.
Hey, Steve, this is Allison in Nashville. How are you this morning?
I'm doing well. Thank you for joining us here.
Yeah, well, I have Tim Davis to thank for that, because I was just on a call with him and he was like, I'm going to the coaching call. And I was like, oh, well, it's on lending. I should go since I'm a lender. Yeah. And I don't have a lot of money, so I need to borrow money for deals too. But lending was a way that I was able to get started because I lend out of my self-directed retirement account. And that's where my capital sat. So it gave me an opportunity to get involved actively in real estate. So one of the things that I will never do is I will never lend to family. And first of all, I can't, or certain family. I can't lend up and down my family tree because of the laws on how you can use your retirement accounts. So that's important to understand. But one of the things I love about lending out of my self-directed IRA and using wraps, I haven't had the opportunity to wrap yet, Steve. I've been learning that strategy because even though you explained it so eloquently, it's really not that easy for me to understand. But for those people who have small amounts in their retirement account, if you build a community and a network of trusted individuals who are doing deals, you can, and maybe also people who have more money than you can actually grow your small self-directed account so much more quickly with wraps.
Yep.
And I've also been exploring and learning about buying notes in my self-directed IRA, which is a little different than lending. So I won't diverge, but I would never lend to a family member, and I also have certain requirements as a lender. I require my borrower to get title insurance on the property. One of my mentors used to say going to a bank is like having to pull your dress up, and show them your panties. So, even though it's a private deal, I still ask a lot of really, probably what some people would consider personal questions. What's your exit strategy? And like, as you said, I never trust the comps that someone sends me. If I'm not that great at running comps, so I usually ask friends to help me who are real estate agents. Are much better at that than I am. So I lean on my network a lot, even to, I have a lot of friends who lend money. Never lending to a friend, leaning on my network. And then I'll never use, so I learned a lesson. I lent to a business and allowed my borrower to put her parents' home up as collateral, which I thought was, oh, great. Now I've got the parents who are there. They're going to help her to, make good on her loan. I ended up having to foreclose on that family's personal home, and I'll never do that again. They paid me off 2 days before the auction, but I actually had friends in the real estate investing community calling me up because they had seen the ads about the foreclosure and my name was all over, even though it was in my self-directed IRA. It said, basically it says Allison's IRA is kind of what it says. But, and so that was a very interesting process and very uncomfortable to foreclose on someone's personal home, So just a few things that I've learned, but.
I love that. I love the fact that you brought up, you can use your IRA, and I do a good bit of lending from my IRA as well. Not to lend to family. I gave the one example of this guy lending to his brother, but I have to tell you, I have, gosh, this is being recorded. I've loaned to family and I don't want to do it ever again. I desperately tried not to do the last one, but I did, and I should have known better. But so those things happen. Leaning on so the exit strategy, and for those of you who may be looking to borrow money, know your exit strategy. And I this is one thing I've always said is I always want to know, how am I going to get paid back? So I want to know the exit strategy. Well, then I want to know, well, if that doesn't work, how am I going to get paid back? And then if that doesn't work, how am I going to get paid back? And you need to be able to answer those questions. And so if you are somebody who's looking to borrow, just know that you can't just say, well, I'm just going to flip it. Well, what if the flip doesn't work out the way that you had hoped it would? How am I going to get my money back? As a lender, we want to know that. And now, again, there's a lot of people who I think who are naive, who are getting into this, and they just think it's all going to work out and everything's going to go perfect every time. And so they just think that you're going to pay them their 12, 13, 14% interest, whatever it might be, and you're going to get the house sold and they're going to make this much money. And it just, there's never a problem. Anyway, it's good to know about the exit plans. I'm going to throw one other thing out here is that I always recommend that you treat it like a business, not a hobby. There's a lot of people who just want to sort of toy around with it. And I think that you should really, if this is something you want to do, begin to establish policies and procedures for how you're going to lend moving forward. Too many people negotiate every one of their loans, and every loan is different. They have different terms. They have different documents. They have different ways that they do things. You're the lender. You get to make the rules. And, my recommendation is that you come up with what you want your terms to be. You get your docs drawn up, whether you have your attorney who are doing them or you're getting them from another lender and you have them reviewed by an attorney. Just get a good set of documents and you do the same thing every time. And now I'll just share this with you. The guy who I borrowed millions of dollars from in the beginning, He was doing about 60 to 70 loans a month. And I learned a lot from him because his business was so streamlined. His terms never changed. He would lend to anybody, but it was 100% value or asset based. And so they would determine what the value was. He'd tell you what he would lend, and it worked or it didn't. You just, and he would do the loan for anyone. And then it was the same title company every time. That title company prepared the docs every time. And so it was just, it was the only way that he could do it, but it took all the emotion out of the business. And by building his business that way, he never turned anyone away. He just simply said, these are the terms. This is how much I'll lend, and you could agree to it or not. And it was just sort of a plain and simple thing. So I learned a lot from him. And so a couple of things to maybe give some consideration to in that regard, if you're going to treat this like a business, is, what are your terms? Stick with them. What is the maximum dollar amount that you would lend to any one borrower? Now, if you're just getting started out and you only have enough money to do one loan, you're not worried about this just yet. But if you have substantial resources, you don't want to put all of your eggs in one basket. Just like any other type of investments, you'll want to diversify. You'll want to spread your money out amongst multiple borrowers, not just one. While I got started out doing second mortgages, I've moved beyond that. I will not do second mortgages anymore. And the only thing I will do are first mortgages. And I want to just do first mortgages on single family homes or other real estate, provided that the value is there. But that's my terms. I have determined, what's the maximum LTV that I want to lend at, so what is the value of this property? I'm only going to go up to 70% of the value, and I won't go above that. And if I'm ever going to make that kind of exception, the way that I do it, and I don't want anybody to get bogged down with this, but for those of you who are more savvy, if this goes over your head, just let it go and don't get wrapped up in it. But for those of you who are savvy, if somebody wants more, I want to know, well, what are you putting into this deal? What resources are you putting into it? And I want them to bring 100% of those resources to the settlement table. And then, so in other words, let's just say somebody wants, $100,000 on something, and I'm only willing to go 80. Well, if they're putting their own money into this deal to make it happen for maybe the rehab or whatever it is, and they've got $50,000 that they expect to put into it, I might put up 100, but I want their 50 at the table, and their 50 is going to go into escrow against the loan, and I'll release that $50,000 to them as they progress, and the value is now there. But that way I'm protected because I only laid out $50,000 at the time of settlement, because of that 50 of it is in an escrow account that I control. While I may have brought 100, they brought 50 with them that I now have control, that if they don't do what they said they were going to do, I can have that in my pocket. So again, for those of you who are savvy, you got that, you understood it. Beyond that, don't let that bother you. Know how you're going to do your due diligence. You could set up things along the lines of, whether or not you're going to collect payments along the way, or you are going to allow them to not make payments. I'm going to just share something on that very quickly. Is I like to collect payments along the way. I understand the wisdom of, allowing people to have 6 months or a year and not make any payments and just collect all of your interest when the property sells. But the issues with that is if I find that an investor who doesn't have to make payments doesn't take your deal as a priority. There isn't the pressure of having to get this thing done so they can get those payments off their back. And they will actually work much harder on other deals where they do have to make the payments than they will on yours. Now, with that in mind, your loan balance just continues to grow and grow and grow. And then I've watched this happen to people before. A year later, this is no longer looking like it's going to be a very profitable deal, and the borrower starts to lose interest. And if they start just keeping yours on the back burner 2 years, and I've seen this happen. I've seen 2 years in, it's no longer a profitable deal for them to get that deal done and pay you off along with 2 years worth of interest. And so I like to see payments being made. Now, we also, the one that I'm foreclosing on right now, the borrower took the money and ran. He took draws, about $45,000 in draws, and took off for Florida, bought a house and a boat, and abandoned the deal. Well, we could not begin the foreclosure in spite of the fact that he abandoned everything. He wasn't doing anything. But he was not in default because he didn't have to make payments. And until that note matured and was due in full, we could not make payments. So I would, if you're of that mindset that you'll take your interest at the end, do something. Put in a minimum payment of sorts that has to be made on a monthly basis, so that if they don't do that, they're in default, and you can accelerate that loan at a quicker pace than waiting for it to mature, like I had to on the one that I did. And I'll leave it at that. Anybody else have any other thoughts or anything that you want to contribute as far as best business practices for a lender?
Well, I know there's a couple other lenders on here. I don't want to be the only one talking, but Steve, you just reminded me a couple of my requirements. Number one, I will also only be in first position on a loan. I will never take second position. Number two, communication is so important to me as a lender. And one of the lessons I learned on that business loan I did was I didn't require that the business owner report out to me any of the financials on the solvency of that business and how it was doing in our paperwork. So when I started asking those questions, all I got was, "Oh, we're doing great." Mm-hmm. So, and it was actually a retail store. So I was able to go to the store. I could see the doors were still open. There was still product on the shelves, but financially I had no idea whether this business was in trouble or whether it was very profitable. The other thing, I only lend on non-owner occupied properties, and I've been enticed to lend to homeowners who, I had a gentleman approach me who was trying to finish. He only needed $50,000 to finish like a $250,000 home. I mean, my loan to value in that situation, I lend 50 to finish a $300,000 home, right? So the ARV is $300,000. That was a really safe financial position. But once again, I would have been if I ever had to foreclose on that builder, I would have been foreclosing on a personal home. So I keep it to only non-owner occupied investment properties, right? Which also keeps me safe from Dodd-Frank, which is something that we have to learn about as lenders, because we're only allowed to lend a certain number of personal residences per year, or else we have to be licensed as a mortgage lender.
That's a good point. I just refer to it, non-owner occupied. We're a commercial lender, and the requirements are far different. And even if you start going into owner occupants, in many states, there's only so much interest you're allowed to charge and things like that. And the default situations are a lot different. So I don't recommend that anybody do owner occupied when you're in this field. And there's plenty of opportunity. You don't have to go there. So I will say this, that every time I have a friend or family come to me who wants to borrow from me, and they're asking, just to borrow money, I tell them, well, here's our policy. We only do first mortgages on property. It has to be secured by property. I don't do anything that's unsecured. I don't do anything like that. And that usually takes care of everything. And then I'll also blame it on my IRA when they're giving me, oh, well, can you just help? And I'll say, well, listen, I just do lending from my IRA, and my IRA requires that I do it this way. It's the way it's written up. And so I just tell them that it's my way of getting out of lending to some. So we have a question here. What is the paperwork you require for lending, promissory note, mortgage. And so, that can get, I always require a note and mortgage or a note and deed of trust, depending upon, the state. And then I also want personal guarantees. I have a full-blown package with, construction agreements and assignments of rents and leases. And so in the event that it's a longer term loan and they're not making their payments, I can come on in and start collecting the rents to offset their payments. If there is money that I'm lending them to do the rehab, I tend to do that in draws. And then so there's construction agreement that comes along with that. And we don't just release all of that money to them at the time of settling on the property, but we do that little by little, and that's what protects our position. All right. Anybody else have anything?
Steve, I'd add a comment related to business functions around what you were just referencing, and that is the construction draws for renovation.
Mm-hmm.
So when I first started in 2015 and 16, that kind of was the area where I made the greatest number of mistakes the earliest. And what happened is flippers were kind of running fast and loose with their construction draws. In some cases, they weren't paying their subcontractors and things like that. So I had to come with a whole different set of procedures around when I released funds for the renovations that were taking place. So at this point, I have a renovation agreement or a draw agreement that you just mentioned that you have also. And then we kind of follow that. The most important thing that I've done to manage construction draws is that my policy is now to reimburse real estate investors for completed work. So the awkwardness for them is that almost all the subs they work with want advances, say a 50% advance to do whatever it is, whether it's electrical, plumbing, drywall, whatever. And so I have part of my spiel when I go through working with real estate investors is that, hey, you kind of need to have some cash sitting aside just to lubricate the wheels, to keep this process going. Ivy Sun Capital does not function very well as an ATM, meaning if you've got, your guy shows up, he finishes today and he shows up at 3:00 and says, I need $560 for what I just did. That's not, I can't function that way. Mm-hmm. So we're going to put a plan together and I'm going to reimburse you for work that's completed. And then there's an inspection process. It can be casual or formal to show that work has been completed. We properly invoiced it for it, and then they get their reimbursement. So how much do they need to make that work? Generally, at least $10,000 they need to have kind of in the bank to pay their subs and buy materials and things like that, put their receipts together and invoices, and then submit it for reimbursement and go on to the next phase of renovation.
Yeah, and I'm 100% with you in an agreement with that. That's the only way that should be done. I always disperse the draws after the fact. And then the other thing is that, like today, and I'm not a real serious lender. If I was going to be a real serious lender and really build a business around this, I would be doing it with construction draws. My desire today is to work with people who have money, who don't need that, and they just, they're high volume enough. They want to borrow the $100,000 purchase price, but they got the $80,000 they need to renovate it, and they're just looking to not drain all of their cash. That's my preference today. That's also probably one of the safest loans you could possibly get involved with, where they're putting all of that money in and your LTV comes way down. But I'm 100% agreement. If I was looking to build a business around doing a lot of loans, I would really dial that in. You get paid for the inspections. You should be anyway. You work in about $100 per inspection is usually the fee. And so that way you don't even have to be the one who does it. You could pay somebody else $50 to do it and make $50 on each inspection. But, and then cutting the check. But those are some of the practices that by all means, if you're going to do a lot of lending, you'll want to implement. Thanks, Steve. Anything else that you want to add?
No, I just reinforce the, being in first position, not second position. You can really be in a weak position if you're in second position. And just reminder that if you're in second position and your loan fails, you have to take out the first position in order to get control of that asset and then have everything work out in foreclosure if it goes that far.
Mm-hmm.
So it's really important to kind of not be there unless you've got enough money in the bank yourself to be able to take out that first position. Ask me how I know. And, it's just one of the things that you can do to protect yourself.
Yes. The other thing about a second position loan is it might look like you're in a pretty good spot when you do that second mortgage, but if they stop paying the first mortgage and start including fees and penalties and legal fees, while the first mortgage might have been $150,000 when you first got in it, that could easily run to 180, 190, and everything that you thought that you had in place, all the equity you thought was there to protect you, has evaporated. And that's a whole other issue with the second. If they're not paying you, chances are they're not paying the first.
One other thing I'd add is take a look at your goals in life. Take a look at the plan you have for yourself. Because even though one of the benefits of being a private money lender is not having to deal with tenants and toilets, not having to deal with subcontractors, not having to actively manage a renovation property. So maybe it's a little cleaner work, but it's still trading time for money. There is still work you have to do in underwriting, servicing that loan, managing the renovation process. And so it doesn't fit with your life goals. And, it can be rewarding. However, you're going to have some time in that. And how big do you want to do? Do you want to go to scale? Answering those questions in advance. And then, Steve, you mentioned having systems in place, really thinking about those systems in advance. So don't wait until you have a loan in default to figure out who your foreclosure attorney is going to be. Try to get that foreclosure attorney lined up. If it's more than a hobby, try and get those systems in place and those providers and service things in place in advance.
Yeah, I agree. You just brought up something else I think is important. Loans do pay off and you've got to turn them over. But just to put this in the perspective, the conversation I had with my friend a couple of weeks ago, he was doing these loans and he said, he's charging 9% interest. I'm making 9% on my money, but he wasn't charging any points. And I said, no, you're not making 9% on your money. You're doing all this work for the underwriting. You're getting all of this stuff done. And I said, there's two things involved here. There's you who has to get paid for the work that you do to get this loan done. And then there's your money that needs to get paid for the work that it's doing. And so the interest rate that you're charging, the 9%, 10%, whatever it is that you're charging, is the return on your investment. The points or the loan fee that you charge is compensating you for your time and effort that you put into this deal. And so he asked me, what do I do? And I said, well, I charge a minimum of $1,500 because that's at least what I got to get for my time to put it all together, or 3 points, whichever is greater. And so if it happens to be a small loan and somebody only wants $40,000, I'm charging them a minimum of $1,500 to do that. If it's a $100,000 loan, I get $3,000 for my time and effort putting it together and doing all of that. And then my money works for me and collects interest on it. So I always tell people don't give up the points and the loan fee, because that is what pays you for your time, and don't forget that.
Steve, this is Mick Kronberg. I have a question about a friend of mine who has done quite a bit of lending in this fashion has recommended that the person you're lending to have a life insurance policy for the amount of the loan and the interest if they're paying you off at the end. And I got a little bit of pushback from the person, from my investor, or the person I was investing in. And I was just wondering what you guys think about that as a practice.
I think it's a little bit overkill. If you're doing your due diligence, the asset has the value, you should be good. Having said that, if you told me I need to get a life insurance policy too, I mean, if I'm the lender, that would be awesome. But if I was coming to you to borrow and you told me I needed to get that in addition and name you as the beneficiary, I would probably not borrow from you.
I'd worry if you were going to kill me.
Yeah.
So let me just say that I know from my own experience that estates can take a long time to settle. Even well set up estates, and it's a guarantee against keeping your money tied up for that in that worst case event. Is how it was explained to me.
Yeah, there's no question about it. There's a risk with everything. We hire a contractor and he can get there and bust the next day. We just pay a deposit. And so with that in mind, the bottom line is while it's going through the estate, you still.
We need somebody. Mike.
Let me just see. I just had to get rid of that echo. While you are going through that estate, you're continuing to amass the interest in everything that is going on, and the estate, and at the end of the day, is going to either have to liquidate that property, pay you off, whatever it might be. But you have a claim against the estate. It's going to continue to work for you, but there's always a risk. I mean, we can sit here and try to cover every single base, and if you can get your borrowers to do that, that's awesome. But at the end of the day, I think you'll lose more loans than you'll get, and especially in a time like today, where, in my opinion, there's more money out there than there's people who need it, and the private lending business is pretty competitive right now. And, I see some private lenders who are lowering their interest rates and doing everything they can to compete and to get in front of somebody else. So I think that would be a hurdle that you would lose more deals from than you would gain. It's just my personal feelings.
Steve, I would add to that one of the reasons investors come to private money lenders or hard money lenders is because there are fewer hoops to jump through. It's more of an asset-based loan than underwriting real estate investors like the banks do. I like to say banks will underwrite you. When they underwrite you, it's 90% you, 10% your asset. With Ivy Sun, it's 90% the asset, 10% you. But still look at you, especially the first time we work together in your entity and your track record. But we don't look as hard at those things. And banks have approached me historically in lending requirements and asked about life insurance, asked about key man insurance for a business and those sorts of things. But I would agree with Steve that if I were to start asking my real estate investors about those things, I'd be a lot less attractive to them because I'd be functioning more like a bank with more and more requirements that they're moving fast and they don't want to mess with that stuff.
All right. So I think, Michael, I think that you've got two things open. So I had to mute you for just to get rid of the echo. But did you have something else? Okay. All right. We have a few minutes left. I think there's been a lot of things that have been shared here. Is there anyone else that has anything that you would like to share as far as lending, business practices that you think would benefit the community? All right. Well, if you are someone who is looking to borrow money, I hope you took something away from this today. If you are interested in lending or lending more, I really hope that you picked up some tips. Here is one thing that I would really like to encourage. I would love to see all of you who are lending, who want to lend, to start participating in the community from the perspective of, hey, would anybody like to share your docs? Hey, and let's help each other to become a better lender through collaborating with one another and seeing, what the best practices are that each other is doing. The business, like I said, I made just under $100,000 last year, and it is a small part of my business. This is not what I focus on. Most every time I do a loan, it's really a favor to somebody. I'm not actively out there looking for them. And when something like that can put that kind of money in your pocket, it's a pretty awesome thing. I'm just gonna look at my board real quick. I have, at this very moment, I have $5,000 in interest payments coming in every month. I just had a loan pay off, but go back a month ago and it would have been $6,333 a month that was coming in a month ago, but just had one pay off. So those are just checks that come in from the loans. I don't have to deal with a tenant. I don't have to deal with anything. One of them I have to call up every month and remind them that the payment is due. And then I always get it a few days after I call them, but it does come in, and the others just come in like clockwork. So it does treat me good. Michael, you have something? You unmuted yourself? Put your camera on?
I joined really late, but I was wondering if I should share with the group the lending option that I used recently, which was basically getting government money at a really low interest rate for investment properties. If that would be interest to the group, it'd take me like 1 minute to share.
Sure, go ahead.
All right, so I recently refinanced 2 properties. One that's a rental, and I moved some debt from a commercial property to it actually. Believe it or not, I got a 2.5% interest rate on a 30-year fixed rate loan, to my surprise. How I was able to do that is I used a lender by the name of Rate Rabbit at raterabbit.com. And they are a direct government lender. So there's no in between people. They do mobile closings, and they will do investment properties. And part of how I got that rate is they offer buy down point options. You legally can, on investment property, unlike your own home, buy down as many points as you want. There's no 3% max. Most lenders will tell you that's not true, but this lender gives out direct money from Fannie Mae and Freddie Mac, and they can do that. So I bought my points down, and although I paid like $10,000 or $11,000 in points, I'm saving more than $200 a month in payments, and I'll save $67,000 in interest. And I figure, well, if I can have my money I'm borrowing at a really super low rate, and then I potentially maybe lend some money to somebody else at a higher rate, that could be a nice spread working it that way. So anyway, I thought I'd just share that with the group quick, because I was kicking myself. I didn't know about this 10 years ago.
Hey, Michael, is that on like single family rentals, or does it have to be commercial?
No, it's I don't know that they do commercial, but I do know they'll do single family rentals. And what I did is I refinanced a single family rental, and I moved a chunk of debt from a commercial one over to it because I was able to get this rate, and they were willing to also do it as a cash out. So by the way, I got the 2.5% on a cash out single family rental refi.
Sounds amazing.
I know. I can hardly believe I got that done. Right. That's why I'm sharing with all of you.
Yeah, thank you for sharing that tip.
That was just last month while rates were going up.
Yeah. Well, yeah. So this was like if I'd done that last year, I might have even gotten a little bit lower rate.
All right. Well, we're going to go ahead and wrap this call up. I see a few more questions just came in. I wish that they would have come in a little earlier, but we do have to get this one wrapped up. Can you please post those questions into the app? We will be happy to get to you and answer them. And I appreciate all of you. I hope that you really took something away from here. So inside of the Lifeonaire app, let's keep the discussion going and help each other to become lenders, become better lenders, or to become better borrowers for lenders. So have a blessed day, everyone. Take care.